welcome to the IRE.IQ Quarterly Fundraising Report review. Thank you for joining us for a look at closed-end real estate fundraising activity, as tracked by our IRE.IQ database. We'll be sharing some trends and data covered by our Q2 2025 IRE.IQ Fundraising Report, which was published Thursday, August 14th. Today, I will be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I'll share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then we will have a broader conversation about fundraising. We also will be answering questions from the audience through the Q&A feature, which you can access at the bottom of the screen. All the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package. But if you are not a sponsor and interested in using our IRE.IQ database, you can subscribe by clicking on the IRE.IQ logo on our website. Now, with that out of the way, I'd like to welcome Thor Eriksen of ORG and Dave Splithoff of Walton Street.
Thank you, Loretta.
Thank you for joining us. Do you think maybe you could start by giving a brief overview of your role and where you sit in the fundraising ecosystem and what perspective that gives you on the market? And I'm going to have you start, Dave.
Sure. Thank you, Loretta. Thank you, IREI. Dave Splithoff, Senior Principal with Walton Street. The perspective that I have and the insights that I can offer. So we are entirely real estate focused. We have a global institutional investor base, and we have debt and equity platforms. With different strategies, closed-end, open-end funds, and we go across the risk-return spectrum from core all the way up to value-add opportunistic. So see it all, and looking forward to sharing my perspective and insights that I can offer.
Fantastic. Thor?
Yeah, thank you for having me. Thor Eriksen here. I am a principal at ORG Portfolio Management. A little bit about ORG. We're a global full-service investment advisor and manager with over 25 years of investment experience. We do work with clients today across the entire portfolio and not just real estate today. And with our clients, which are all, I focus on US, they do invest globally. And so we have a good perspective across risk and return globally.
Wonderful. I'm going to go ahead and start the presentation right now. If you'll just bear with me for one moment. All right, let's get into it. So what we are looking at here is closed-end funds investing in direct properties, equity, or real estate debt. For this current report, we're sharing data on funds with a final close between April 1st and June 30th of 2025. And I say this every time, but it's really important to remember this is a snapshot. It is possible additional funds have closed, but haven't announced yet. So, our IRE.IQ team, they learn about fund closings continuously as the year goes by. We're always updating the data. But I do think the overall trends are still useful to indicate what is happening in the market and to give some guidance to investors and managers. So, as a reminder, we will be taking questions from the audience through the Q&A feature at the bottom of the screen. I do encourage everyone viewing, go ahead and type in a question. My IRE.IQ colleagues will be able to answer some of your more technical questions about the data set. And I'll be following and monitoring that just to pose those broader questions to Thor and Dave and get their insights as well. So let's take a look at this. $22 billion was raised by 26 funds holding a final close in the second quarter, according to our research. And this was definitely a slower pace than the previous quarter when 30 funds held a final close of $50 billion. but it's still more than the $13 billion that was raised in the fourth quarter by just 18 funds. So I guess my first question, and I'll start with you, Thor, is does this data match more or less what you're seeing in the market?
Yeah, I mean, I think it looks that there's more activity in the market, more funds, more capital being raised this year. I think that it was kind of I think a slow 2023 and 2024, and I would say at the beginning of the year in 2025, I would say there was a significant amount of excitement around real estate, and then post Liberation Day, I think things slowed down, but I think generally speaking, overall, it does seem that the capital raising and is increasing this year compared to last year.
Dave, anything to add here?
Yeah, I think it's still a difficult fundraising environment. Maybe you see some green shoots. Maybe you see an uptick in the first quarter because funds being raised kind of extended into the next part of, going from 24 to 25. But I think real estate is starting to be viewed more favorably, given the reset in the market that's taken place. Now, it all depends on investors being able to have capital to put out and getting distributions back. And that kind of feeds on itself. So transaction volume needs to increase, which I think it is. There needs to be stability in pricing and in the market to allow for that to happen. And I think you're starting to see that. So investors will get their capital back and be able to redeploy it into funds that are coming in the market. So it's still not easy out there, but I think it's getting better.
Yeah, I would add too. I think it is a really difficult capital raising environment, and certainly now I think the fundraising period seems to be taking longer than in the past, where typically it might be 12 months, but I think it's starting to see more common where the managers allowed more time to raise more capital. So it'll be interesting to see how that impacts the data kind of going forward.
I do have a question from the audience about how many of these funds that closed in the second quarter were first funds. I don't have that number straight in front of me, but we do have the whole list of funds, and we will be able to, if you let us know, just email me after and I can get you that information. I also have a question about the breakout of equity versus debt funds, and I will tell that person, you're getting a little ahead of ourselves because that is the very next slide. So real estate debt funds. Real estate debt funds, they continue to represent a pretty significant portion of the capital being raised, about 20% of fundraising in the past 18 months. It was a little closer to maybe 12% in 2022, 2023, according to our data. And in just the first 2 quarters of this year, $15 billion was raised by real estate debt funds, according to our information. I want to start with you, Dave. What are your thoughts on real estate debt fundraising in the current environment?
Yeah, I think there's a lot of interest in real estate debt. I mean, we're feeling it on our platform. Our viewpoint is that it's a great, it's a good time to be a lender, right? So there's tremendous opportunity. If to summarize it, if an asset was worth $100, it's probably worth, at the peak, it's probably worth $75, $80 now. And if you're doing a 65% loan, you're at 50, 52% of where peak pricing is just a few years ago. So you feel really good about where you are in the capital structure. You have a lot of equity, borrower equity that's supporting that. And you can make an attractive return in the debt. I still think there's an education process that goes with investors wanting to be in debt and understanding the different profiles of these funds. Are you looking for current return? Are you looking for equity-like returns? Is this a loan-to-own strategy? What levers are being pulled to get to those returns? Because somehow they're trying to create, you have to create the returns, with back leverage or whatever it might be. And that's an education process. But I think it's a great time for real estate debt. I think there's a lot of interest in the market. And that's also not just real estate debt, but private credit more broadly, becoming a bigger investable universe. So I think you'll see that number continue to increase. And as people become more aware of all the different strategies that are out there, figuring out where they want to place the capital will be the biggest thing.
Or what are your clients feeling about debt, real estate debt in particular, but private credit as well?
Yeah, that's well said, Dave. Historically for us with our clients, we've always taken the approach that real estate debt is attractive in a client's portfolio. It is ultimately in certain situations, their decision whether they put it in real estate or fixed income. But we have always found debt attractive for our clients. I think to Dave's point, I think it is really exciting to see the number of closed-end real estate debt funds being raised today. Obviously, banks, we've noticed a significantly pulled back in lending. It does seem they've kind of started to come back. But it's also, it seems like going forward that banks are going to continue to want to lend and kind of provide that back leverage and they get more favorable capital treatment that way. I think there's around 4,000 banks today. I think that's going to continue to come down. We'll probably see more consolidation and mergers, but I think banks will become more active on the equity side too. But I think I view it as a positive for the overall in the real estate industry that we're seeing more real estate debt funds, because I do feel that real estate debt funds in particular, you just have a better understanding of the real estate. So I think that's exciting. I think today's point about how funds are financially engineering returns, I think that's really important to understand. Whether how groups are using and negotiating things such as credit facilities and repo. I think that's really critical to understand. You have to have the infrastructure as some of these managers to run a debt fund. It's much different. I think it's more capital intensive. So I think it's really important to understand today.
I do have a question that's come in, and not to put y'all on the spot, but kind of asking a question about managers that are maybe just debt tourists. They've started doing raising real estate debt fund just as a way to keep things going, versus those that had decided to go all in on debt over the long term. Do you expect debt strategies, these debt tourists, to fade away as things shift in equity? I don't know which one of you.
Potentially, we'll see. I mean, I guess it depends on how well they do in the time that they're in debt and what the market opportunity looks like. We have fully built out our debt platform. We've had the debt platform for over a decade. So it's an area that we are very excited about and looking to grow going forward. But it it there's a it depends. Like ours is a whole loan origination strategy. So, we are controlling the loan and then using back leverage to make our returns. Other people are buying mezzanine. Like there's so many different buying mezzanine debt off of Wall Street desks. Like there's so many different ways to get returns, and whether you build out a full team that's focused on originations or not. Um, I don't know. I think when the opportunity on the equity side, which in my opinion seems to be there as well. I think, real estate equity looks like a good opportune time to put money in the market, that you may see more capital also go over to the equity side because of the upside potential too, right? You're not going to make in debt. We always joke on our platform, there's not a lot of borrowers that are willing to pay you back more than you lent them, right? So that's where the opportunity comes in equity. And as distributions come back and people have capital to invest and there's a real opportunity there, I think you're going to see money flow into the equity side too.
Yeah, I think it would just take time. I think some will do well and continue to raise continue to raise funds, but it's really going to take time. I think the one comment that made me think about is, our partners or clients, they build these relationships with managers, and you want them to have the capabilities to capitalize on the opportunities that they're seeing, right? We build this relationship with those groups, and I think that's the last thing we want to do is if we kind of lose that trust. I think that's kind of the most important part. But yeah, I mean, it really just take time. I think, over time we'll see what happens.
So one other thing I'd add, my perspective, and we talk about this a lot with our investors, is the debt business is really not an off-market business. It's probably the most brokered business around, right? If you were going to refinance your home, you wouldn't just go to a close friend and say, "Hey, would you do this?" You'd want to run a process and see what the best cost of capital was. Well, it's no different in terms of financing an asset. You're going out to all the different groups and you're seeing what the pricing is. And then at some point towards the end, it becomes a relationship business where, you may give a last look to where that group that you want to work with needs to be in terms to win the origination opportunity. So the staying power, my point being, relationships really matter on the debt side, and those groups that are willing to build these relationships with borrowers over time, and scale that way, are going to have staying power and have the most success. So if you're not willing to do that and kind of see it through a longer period of time, that's going to be harder for those groups to continue to grow.
Right. I think, yeah, and to add to that, I think just kind of talking about how these groups are creating debt funds today, I think it is, capital intensive. You need a certain number of people to manage and operate these funds, that have the relationships in the debt industry. So I think, when we're looking at opportunities, it's really important just to look at the group, the experience, what they've done in the past, and because oftentimes you don't have some of these funds don't have predecessor funds, and it may not be what kind of you're used to seeing.
The final point I'll make is like groups that are starting to get into the debt side, even if it is a new fund, I think it's advantageous and a competitive advantage to have debt and equity. They're different underwritings, but to have the perspective on both sides of the house, and even if something were to go wrong with a loan, to be able to take over the asset, as a could be an opportunity. That's an advantage. It's not a requirement, but I do think it puts groups in a different position.
I'm gonna go ahead and pull up the next slide, which is taking a look at average fund size. As you can see, average fund size in the second quarter was less than $1 billion, and the median fund size was just over 500 million. So, the majority of funds were definitely on the smaller side. There were a few over $1 billion, but we are seeing, sort of an up and down. Q1 had a number of mega funds, so that pushed up the average fund size. It kind of, seesaws a little bit depending on which funds hold their final closing. Do you think that the smaller fund size, is this just sort of noise, or do you think there is something here?
I think it's part of it is the difficulty in raising capital. So groups are doing the best they can, and they're going to close what they have because they don't want to miss what we think is an attractive opportunity to put capital to work. So they're going to invest what they have. They're going to do a great job investing it, and then come back to the market and say, we'd like for you to reinvest and go at it again. I think the key with all of this is to be able to raise the fund in as an efficient time period as you can and invest it in that window, because if it takes too long, you start to go into the next cycle, and that's when it really impacts the returns of the funds. So whatever you can raise and whatever set time period is to raise it and invest it, that's what you should do. And the size is what it is. Everybody has a target that they feel comfortable with. But to me, it's about being efficient and timing it right, especially in these non-core funds, because otherwise you're going to inevitably run into a cycle and it's going to impact your returns.
Anything to add on that, Thor?
Yeah, it's interesting data to see here. It looks like obviously a really great fundraising quarter for first quarter. It looks like significantly more than last year. But yeah, I mean, it looks like it seems from my perspective that I think the fund size is going to be, I think, smaller than what managers are expecting going forward. But I could not agree more with Dave. I mean, if groups, we want groups to be to raise the capital and be investing right away. That certainly impacts returns. But really much different today, it seems, than a couple of years ago. Where it seems like funds were raising capital in 6 months, and where you'd have a blind pool. But today it seems like significantly more situations where you have groups raising capital where you're seeing pre-specified funds, and depending on the fund, the opportunity, that looks attractive too. In terms of kind of what's happened with valuations and today.
Do you find, with these sort of pre-specified funds, does that give investors a little bit more comfort knowing what they're getting into, Thor?
Yeah, absolutely. I mean, I think you do have to be cautious because, I think people, generally speaking, have felt more comfortable around valuations in real estate. We've talked about, I think a lot of investors out there in the industry benchmark to NCREIF Odyssey, and it does seem kind of valuations have bottomed. But I think only time will tell. I mean, but yeah, I mean, I think it's really situational. And I think a lot's changed since the end of 2024 to today. So I think you really just have to have. I think the point I'm just trying to make, I think you really have to have the capabilities to underwrite the real estate. And you just need to be, I think you just need to be out there more. We have an open door policy, meet with as many groups as possible. And I think that's just kind of the best way to approach it right now, just to really understand what's going on, because it's so much has happened from Liberation Day to what's going on with tariffs and just so much volatility in the markets happening. I think it's critical more than ever to really understand the real estate.
Yeah. Coming off of that comment about Liberation Day, this is over the past 12 months, this is where investment is being targeted toward. In the second quarter specifically, more than a quarter of the capital was raised targeting European real estate. Coming out of Liberation Day, pretty much the entire second quarter was post that announcement of tariffs. What interest are you hearing from investors about non-US markets versus US markets? And Thor, I'll start with you on that.
Yeah, I mean, it does seem there's more interest in Europe and Asia. Europe, I think, for it's attractive for a number of reasons, but obviously, low cost of debt. And it does seem though now that that's kind of continuing to happen. But I would say overall, I think there's continued to be a strong domestic focus.
Dave, anything from your perspective?
Yeah, I think that, I mean, we have a large non-US investor base. You saw, depending on the location, just I think a pause or with Liberation Day, trying to understand what are the impacts, like what's happening there, and groups starting to explore other markets outside the US to see what opportunities are there. Now, there's a lot of considerations. If you look at the hedging costs for groups in Japan and different parts of Asia, like they can be very meaningful. So that means they have to invest within the US if they're going to do it. They really fit a certain profile of the fund to make the investment worthwhile. And some of those hedging costs have become very, very significant. I ultimately think that even if groups have turned away from the US and tried to look elsewhere, they're going to come back to the US. It's the most stable market. You can still make very good returns, and they're going to have a meaningful portion of their allocation to continue to be in the US. And it just may be a little pause in terms of if they were going to invest at the end of last year, maybe it's a 6-month window that they'll come back. But I do think they're going to come back in a big way.
Now, obviously, this data was collected in the second quarter, which is, those first 3 months of sort of tariff. Are they, will they, won't they? What will the impacts be? Projecting ahead, do you see any of the trends? What sort of trends do you see going forward, Thor?
In terms of
In terms of,
investment
yeah.
activity?
Yeah. Do you think that there was sort of just a momentary blip of, oh, we got to look overseas, or do you think this will be sort of an ongoing conversation?
Yeah, I think it would be kind of, well, so first of all, our clients are long-term investors. So I think, what we're seeing happen is not having a huge impact. I think, we're at the end of the day, our clients are long-term investors. And so I think it's something we obviously need to continue to watch and monitor. But I think, our clients are long-term investors. And we work with U.S. Our partners are U.S. clients, and I do feel there's continue to be a strong kind of domestic focus going forward. But I think to Dave's point, I think the U.S. continues to be one of the most resilient economies, and I think there's always that return premium or the kind of opportunity cost of investing internationally, and it sometimes looks more attractive than it actually is on paper.
I'd also add, like, there was concerns with Article 899, the big beautiful bill, and what that would do. I mean, we had a lot of conversations with non-US investors and the implications, and they were waiting to see if that would stay, and it was taken out. So I think that is a positive thing for non-US investors to continue to want to invest in US focused real estate.
Now, I don't want to spend too much time on this because typically closed-end funds do focus on higher return strategies. So it's no surprise that if you look over the past 12 months, that they have garnered the majority of capital. And I just want to, as a side note, mention many of the funds that fall into the not disclosed category do focus on real estate debt. Just given the way real estate debt works, a lot of managers in that space don't really specify a core value-added or opportunistic investment strategy. I will say, however, that maybe about a year ago, we saw fundraising pretty evenly split between value-added and opportunistic, and we might be seeing maybe a slight bias toward opportunistic funds. Although in the second quarter, we once again saw a pretty even split come through. What do you think might be driving any trend toward opportunistic versus value-added in the current market?
I'll take that one to start. I think that it's a search for returns that can compete. I mean, if groups have limited capital and they're looking at real estate versus venture capital versus private equity, and they want to do they're looking at the return profile, they need to opportunistic real estate is a search for higher returns and the ability to compete with those other types of investment opportunities. Because there's an opportunity cost of whatever group you go with, you're not investing in the other. So if you have limited capital and you're searching for higher returns, that's where maybe they're looking to go to opportunistic. And they're also looking at the the market opportunity in play. There's a reset in pricing. Maybe it's whatever the dynamic is that's leading those opportunistic funds. I think it screens positive. And that's probably where the capital is going and the reasons why.
Yeah, yeah. I mean, it's kind of tough to distinguish between the two kind of investment styles and funds. I think it's just important to mention. I would even mention that why not just take away the what they call the investment style and let the client, the investor, figure out what the risk actually is for their own portfolio. I think sometimes we get maybe too enamored by maybe what it's called out in the marketplace. I think it's really important to understand, how groups are taking risk, how are they getting to returns, especially today. I think that, you have to, it's really, in a low returning environment, it seems in my opinion, I think it's really important to be investing with groups that really know how to make the returns work, how to improve income and reduce expenses. I think that, and maybe that's what's people are seeing, some of the opportunistic groups. I don't know. I could see this going the other way next quarter. I don't really have a great reason why it's more for opportunistic versus value add. I mean, it could be similar strategies.
It sounds like you're really making an argument here about due diligence and underwriting being paramount. Is that right, Thor?
Yeah, absolutely. I think that just understanding how groups operate and how they're really making the returns work. How are they getting, show how you're getting to your returns. And really, I think it's important to really understand that today. Because as we mentioned earlier, there's a number of groups that are raising first-time debt funds or sector focus or going from diversified to sector focused funds. And do those groups really have the expertise and experience in those areas? It's not necessarily whether it's core plus, value add, opportunistic. Like really, I think it's important for groups to question managers, how are they getting to their returns? And I don't know, maybe going forward, this will be more value add. I don't know.
Yeah.
Loretta, it's not represented on the page because it doesn't track open-end funds, as you pointed out. But I actually have felt a sense of more investor interest coming back into core and core plus real estate,
I,
right?
what are you seeing on the core open-end fundraising side?
Yeah, it
Uh,
definitely does seem there's more
uh,
capital being raised by core funds. Sorry, Dave. Go ahead.
no, go ahead.
Yeah, I think we've noticed that too. I think, just kind of touching on the comment around the NCREIF Odyssey earlier, I think that valuations do seem to have to kind of come down. Replacement cost is up. And I think it's something that we're starting to see more and more, starting to look more and more attractive. And whether it's core or core plus. But I think that will continue. It seems to happen over the year.
I think investors, there's this kind of like group think or group mentality of um, not wanting to be too early in terms of going back into open-end funds and investing in core plus. And you've seen values that have, from peak have come down substantially and have kind of flattened for a good period of time now. And now investors, I think, are shifting a little bit from not wanting to be too early to not wanting to be too late in terms of reinvesting and putting money back into the market. And I think that's a real positive. You can see in the Odyssey funds, the queues are the queue to get out is coming down. It was at all-time highs, still very high, but I think you'll see a lot of investors are like just going to be when you start seeing appreciation and values go back up, they'll be like, you know what, just leave it in. Maybe they've negotiated a better fee structure on the capital that stayed. Um, but you kind of saw that after the GFC too. I mean, it was a good time to be. I'm not saying this is the GFC or that you'll have a rebound like it, but I do think you've had stabilization in values and you're starting to see it's a good opportunity to invest. And I think you'll see values more likely to go higher than lower from here.
Yeah. I've got the key takeaways. Here's a summary of the report's key findings. And just for those of you watching, this fundraising report, I'm getting a number of questions about some of the more technical details of, can you answer this question? Can you answer that question? It's actually all in the report. So we do encourage everyone to get a copy of the report, dig in. Some of those questions you're looking for can be answered in there. I'm not going to go through these bullets one by one. Instead, we'll just sort of take a few more questions from the audience because I do have a few that are pretty interesting. One question is about secondaries. So what are you seeing for these open-end funds? How are secondaries impacting the market for open-end funds? And do these trades help alleviate the exit queues?
Yeah, I think they're a source of liquidity that gives people distributions back that they're craving, and then they can redeploy it into the market at a better, an attractive entry point and opportune time to invest. So they are, in my opinion, good for liquidity and getting things rolling again in the market. So I don't know what the pricing is currently. I've heard report, it fluctuates so much. It's probably higher than it was before. I think it's come back. But I think they serve a really important role in providing liquidity for investors.
Yeah.
Yeah, I think it's a great point, Dave. It does serve as a great source of liquidity for investors. And I think it's a positive overall from the industry that we could continue to see more capital being raised, focused on secondaries in real estate and private equity too.
Yeah.
What looking at this, we have a question from the audience about sector specific versus diversified funds, what you might be seeing, just looking at what we saw in the second quarter, more than half of the funds were looking at, quite clearly diversified funds, and of the others, anything that was sector specific didn't account for more than maybe 10% per sector of the total capital raised. So it did seem like we're seeing more diversified funds versus sector specific just in the second quarter. Thor, why do you think we might be seeing that? Is this maybe a trend you're also seeing?
Yeah, that's interesting. I read that in the report too. It's because I think you started to see more diversified groups raise sector focused funds, and it sounds like that trend is now reversing course. Um, Honestly, we'll see what happens. It's I mean the correct the I would tell you I don't know. We'll see what happens. I think only time will tell. But I could see kind of more sector focused groups and maybe some of the diversified funds going forward might only focus on a few sectors. But I think that overall, what I would want to see is even if a group is raising a sector focus or diversified fund or multi-strategy fund, I think the importance of just diversification is really important. And not having a fund with 5 or 10 investments, like truly creating diversification in your fund, whether it is sector focus or multi-strategy. I think that too many times I think groups end up investing in one asset that becomes too much of a fund, and then that really kind of just destroys the entire fund performance. So I think diversification is really important, whether it's either one.
Dave,
I think
do you see interest growing for sector specific or for diversified or?
it really depends on the type of investor and what their portfolio looks like. So for example, if you are a large pension plan or sovereign wealth fund, and you have a lot of capital to invest, and you can create, your portfolio where you're giving hundreds of $1 millions to multifamily and then hundreds of millions to industrial and student housing, and you're creating your portfolio that way. That's great. You have a diversified portfolio. If you have $100 million to invest in real estate total, it's harder to do that. You need to go to a diversified strategy to be able to do that for you, right? And so it depends on the investor size, and how much capital they have to put forward. I also think that, for a period of time, if you had invested with just, a manager that was solely focused on industrial or multifamily, probably did very well, right? And now that opportunity set is not as clear in terms of what the opportunity is going forward. So going to a diversified strategy has its merits in a market like this, where there's been a reset in values across the board, and you have the ability to shift and find relative value. Even in like housing, you can go from multifamily to student housing, and then to senior housing, and to single family rental or manufactured housing. And the ability to go from one to the next based on where the opportunity is, I think, is advantageous. So there's an argument for both. I come at it from a diversified portfolio and strategy perspective, so that's where I lean, but doesn't mean it really depends on the investor.
When it comes to the launch of new funds, in the second quarter, we saw a continuation of the slower pace from the last 12 months. What do you think might be driving that slow pace of new fund launches? Start with you, Dave.
Slow pace of new fund launches. I think there's a lot of soft marketing going on, and people aren't officially launching until they feel like they have line of sight on capital that's ready to come in, right? And that's fine. I still think it's challenging for investors. They need distributions to come back in order to reinvest the capital. The market, there's all these different factors that have been part of the conversation in the last few years, from the denominator effect to whatever it might be. And now the market is at all-time highs, so there should be theoretically more allocation to go to real estate. But if they're not getting their capital back, that makes it tough. And then you're starting to compete with private equity and infrastructure and venture capital for limited capital to go around. So there's less capital, which means slower fundraise periods and longer fundraise periods. So I think people are just delaying.
Thor?
My answer.
Yeah. I think Dave is spot on. Summer is typically a slow time anyways, especially internationally. And so I would expect it to increase here once we we're close to kind of the end of the third quarter. And I would expect it probably to increase as investors look to make allocations before year end. Yeah.
Yeah, I think it's interesting, Dave. You mentioned the idea of this sort of soft launch that nobody wants to mention that they're marketing, but they're marketing, just sort of sliding it out there, testing the waters. Another thing that we hear people maybe testing the waters on are continuation vehicles. I know we've seen a big uptick in that. Thor, what is your sort of perspective from your clients? How are they approaching these?
Yeah, it's a good question. I would tell you that I think first off, I think it's something initially, we look to review before making that initial commitment in the fund if the manager has the capabilities to do that in the first place. So I think that's something that we want to know going into right away. And it just depends though on the client and the situation. I think, obviously with some clients investing in a closed-end fund, there's an expectation that there's going to be, a liquidity event at the end of, 7, 10 years. Um, but at the same time, you don't want to, be forced to sell an asset at a significant discount, right? So it's kind of a delicate balance. You see some groups where they're trying to, um, create, seed another fund with some of their existing assets in a prior fund. I think the important point I would make there is, you can always go and get a third party appraisal, but in our opinion, you're always going to get the best pricing if you take it to market. And I think that's always the debate we have with groups is are you really getting the best pricing for our client by creating this continuation fund or this different strategy to seed another fund or opportunity. I think it's tough. I think there's been a lot of pushback really on in the industry, and I don't feel that it's been that successful for groups creating continuation vehicles going forward. But I understand it. I don't, you don't want them to take a significant discount. So it's just tough. Yeah, not a perfect answer. I don't have a perfect solution for it, but I think that I think communication is just key, especially if that's happening, and we just want to hear as much as possible what's going on, and I think the more it's communicated, I think the better groups will be off.
I have another question from the audience, and I think this builds on, Dave, you were talking a little bit earlier about like sometimes it's time to just sort of call it and close the fund and move forward. How long is too long for a fund to be out raising capital? When should GPs stop raising and move on, even if you're below target or a prior fund in the series?
Hmm. It's a good question. I mean, I don't know. Ideally, you have this window of 12 to 18 months to raise a fund, and then 3-year window to invest. I mean, because otherwise you start to run into these cycles, and that can be problematic for the returns. And also, there's different fund dynamics that come into play in terms of you know, how IRR and all that works. And you want to have your early deals be very successful because it sets the rest of the fund up for success. It's all a timing thing, because the investments that are successful at the end of the fund generally aren't as impactful as investments that are successful in the beginning of the fund, right? Just with moving the needle. So if the manager feels like they have enough capital to build a portfolio that makes sense, to me, that's the time. There's no perfect answer. And take advantage of the market opportunity, have a very successful fund, and then come back to your investors once you've made distributions and you can show them what you've been able to achieve. And if you do a good job, I think that they will come back and you will be able to raise more capital.
Thor, anything to add on?
Yeah, I think 12 to 18 months seems like a good amount of time. There's also the valuations to take into consideration too, where I think there's requirements for them to value the assets every 12 months. So yeah, I mean I think you want to see that capital invest to be invested by a manager and returned so we can continue to invest going forward. So I think that's kind of the most important for us.
I've got another question. Will there be a shakeout of a managers? Is there enough capital available to support all the GPs looking to raise funds?
Uh,
Will there be a shakeout?
Meaning,
Oh,
yeah,
I see.
I think those
Um,
that prove their merit and are successful are going to continue to grow. I mean, that's like any business. Others will have to change and adapt and evolve. But if you continue to deliver for your investors, you're going to keep growing and thriving. And I think what's most important right now in conversations I have with investors, distributions, are critical. IRR is one thing and multiple and the returns, but I think right now investors are willing to give up some of that. Not obviously they're return driven, but get distributions back so that they can reinvest either in your next fund or wherever they might want to invest it into what many view as an opportune time to be in the market. So sacrifice some returns to be able to put new money to work.
Thor, distribution's king.
Yeah, distributions are key. Yeah, I think we'll probably will see more consolidation across kind of managers, and if this is kind of where you're going with the question, kind of going forward. But you never know. I think something to think about is just the importance of just alignment of interest between the LP and the GP. There's a significant number of public companies today that are raising funds, and it's a much different alignment of interest compared to a group that's not publicly traded. And I think you think back to the GFC, and I think there was a lot of capital allocated to a few number of groups, and I think it just goes in it goes in waves, right? I think we'll see what happens, but I think that's the only kind of comment I make. I think alignment of interest is really the most important for us when we underwrite groups.
We don't have too much time left in this call, but maybe you could each of you kind of share maybe your outlook for the market over the next 12, 24 months, where we sit now, what we can see in the future versus what's happened. Are we going to maybe see a shift in sentiment going forward? What's your outlook, Dave?
I think it's a positive one for both debt and equity. You have reset pricing. Okay, you're pretty meaningfully off peak. If an asset was worth $100, on average, it's worth $75, $80 now. Obviously, more or less depending on the sector, but just on average. And on the equity side, you can buy high quality assets, newer assets, well below replacement cost, well below peak pricing, and you've got some favorable dynamics working in your favor that to me signal it's a good time to be investing over the next several years. So strong vintages ahead. I feel like real estate has taken a hit overall in terms of pricing, and that's going to come back in our favor. From a debt perspective, same dynamics are helpful to the debt side where you're lending I went through it before, at an attractive point in the capital structure on reset pricing, and you can still make a very attractive yield, being at 65% loan, right? And if there is some if a lowering of rates, you can get SOFR floors, 3% or higher. So there's protection against degradation of returns. So it works from both sides right now. And so I feel optimistic, right? It is a difficult capital raising environment still, but I think that is easing, and there will be flows coming back. And then we talked about it before, investors kind of shifting away, and maybe some from the US for now, but starting to come back and remaining optimistic or have a favorable view on the US in terms of putting new capital out.
Thor?
Yeah, I would say we're optimistic about the real estate market. We view that the fundamentals and valuations have started to look more attractive. And I think I would just tell everyone that, it's important just to not take vintage year risk. No one can time the market. And I think that's probably one of the worst decisions kind of investors can make is when they try to time the market. And I think real estate will continue to play an important role in our clients' portfolio as a great source of diversification. Um, these private real estate funds, are are low correlation and to the public market. So I think especially in times of uncertainty, I think it will continue to serve as a great source of diversification for our clients' portfolios. And I think that, depending on where we are in the cycle, I think it's just important to continue to be actively managing your portfolio and looking and always be looking and open to other ideas and investment opportunities, whether it's core plus, debt funds. I think it's really important just to be open to different ideas depending on where we are in the cycle.
Thank you. I'm going to have each of you share maybe one key takeaway for our audience as we begin to wrap up. Dave?
One key takeaway.
You can have two.
Okay. I think I guess my key takeaway is it's a good time. If you have capital to invest, I think it's a good time to put it to work, be it debt or equity. Make sure you understand if it's on the debt side, make sure you understand the different risks that you're taking and have a targeted view of what you're trying to achieve. There's no upside in debt, right? There's attractive current yield and return, but you're not going to get, no borrower is going to pay you back more than you lent them, right? And on the equity side, I am starting to feel it. I mentioned it earlier, a lot more interest in the open end, like core plus universe, and I think that's great. I think that can serve people very well over the next several years, because if we have any kind of resurgence in values, if cap rates compress even a little bit, there's a lot of that's a good place to be. All right, so that's a positive. I'm optimistic, put it that way.
Thor?
Yeah, I would say my key takeaway and looks like from the great data you provided everyone, it definitely seems like there's just more options today for investors, whether it's open end, closed end, whether it's equity or debt or single sector, diversified to secondaries. It does seem going forward that there's more options for investors to kind of invest and to kind of look at how they want their portfolio to look at going forward, which I think is really exciting for our industry. And I'm looking forward to seeing what happens next.
Well, I just want to thank you all for joining us. I'd like to thank our panelists. I'd like to thank our IRE.IQ Data Services team, especially Nico Pepis and Director Karen Palma, as well as the rest of my colleagues for putting together this information. For the audience, as a reminder, all the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package. If you are not a sponsor and interested in using our IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. Our next IRE.IQ fundraising report review will cover third quarter fundraising, and the webinar will take place November 11th. Thank you all. Have a great day.
Thank you.
Thank you very much.